The UK's 30-year gilt yield touched 5.78% on Tuesday, a level not seen since 1998. The 10-year crossed 5.1%, an 18-year extreme. And yet, buried in the same day's news, the Times ran an analysis with a headline that should not coexist with those numbers. The UK economy is holding up. That tension is the story today. The session opened under dual pressure. HSBC, Europe's largest bank by assets, reported first-quarter profits down 4%, missing analyst estimates, with a $400 million fraud-related charge tied to private credit exposures in the UK dragging results lower. The bank also set aside an additional $300 million specifically for deterioration in the economic outlook, tied to the Middle East conflict. FTSE 100 opened in the red, pulled lower by banking stocks across the board, compounding the anxiety already radiating from the gilt market. The Iran war backdrop explains much of the macro fear. The effective closure of the Strait of Hormuz has sent Brent crude above $110 per barrel, up roughly 80% from the start of 2026. UK long-term bond markets have reacted to the oil shock by pricing in a sustained inflation surge, combined with a growing political risk premium ahead of Thursday's local elections. Labour is expected to lose hundreds of council seats, with speculation building about a possible leadership challenge. That political volatility stacked on top of an energy price shock has pushed UK yields beyond what other G7 peers are experiencing. Traders specifically cited the UK's more inflation-prone economic structure and the electoral calendar as reasons the gilt market has sold off harder than France or Germany. Nissan added another layer of industrial stress to the session. The Japanese carmaker confirmed it is closing one production line at its Sunderland plant and cutting approximately 900 jobs across European operations, roughly 10% of its regional workforce. The company said it is considering a third-party partnership to keep the Sunderland facility running at capacity, but the strategic uncertainty around the site adds to a broader narrative of industrial fragility in UK manufacturing. The FTSE 100 closed lower, dragged by HSBC, general insurance names, and sentiment-driven selling across rate-sensitive sectors. And yet, running alongside all of this, the UK economy, according to available data through midweek, is still growing.
The divergence matters because it is unusual. Normally, when a government's 30-year borrowing cost hits a 28-year high, it reflects either fiscal credibility collapse or an economy generating so much inflation that the central bank has no choice but to push rates structurally higher. What makes the current UK moment different is that neither of those clean narratives fully applies. The fiscal situation has not materially deteriorated this week. The yield spike is largely imported. It is the global repricing of inflation expectations driven by the Hormuz closure, not a UK-specific credibility event. The UK's exposure to energy price pass-through is higher than peers, which explains the gilt premium, but that is a flow-through from an external shock, not evidence of domestic fiscal disorder. The Truss mini-budget in late 2022 produced a similar yield spike. Gilt yields briefly surged past 5% on the 30-year, but that was driven by unfunded domestic tax cuts that directly threatened debt sustainability. The mechanism was completely different. Today's move is an oil shock inflation trade, not a fiscal panic. The inflation trade is what makes the economy data so confusing for bond investors. If energy prices stay elevated, the Bank of England faces genuine pressure to hike, or at the minimum, delay any cuts for far longer than the market priced even 6 months ago. In that scenario, 30-year gilt yields at 5.78% are rational, even conservative. But if the economy is genuinely holding up, if consumer spending has not collapsed, if firms are absorbing energy costs without mass layoffs beyond the Nissan announcement, then the bank has more room to navigate. The BOE's own split vote, 7-2 to hold at its last meeting with 2 members pushing for a hike, already reflects this internal tension inside Threadneedle Street. The HSBC fraud charges add a specific complication. The $400 million loss came not from a UK corporate credit deterioration, but from a secondary exposure on a private credit securitization, a fund-of-fund structure that obscured the underlying exposure. CFO Pam Carr said the bank sees nothing comparable elsewhere in its high-yield book. That reassurance matters because if the fraud is an isolated incident rather than a symptom of broader private credit stress, the systemic risk reading embedded in HSBC share price drop may be overcooked. Private credit globally is estimated at $3.5 trillion. Even a small correlation of fraud or mark-to-model problems across that pool would be consequential, which is exactly why regulators have been increasing scrutiny of bank exposures to the asset class. The counter-signal, the one thing that breaks the clean bond market is right argument, is that UK PMI data just weeks ago printed at 52.0, still in expansion territory, while continental Europe had already crossed into contraction. If the economy has started to crack in April or May data not yet published, the bond market is simply prescient. If April PMI holds above 50 when it prints, the gilt sell-off looks like an overshoot. The 5.78% 30-year gilt yield is the verification benchmark for everything that follows. That level encodes a set of assumptions. The Strait of Hormuz remains effectively closed for months, UK inflation reaccelerates to or above 4%, the BOE is forced to pivot hawkish, and UK political instability after Thursday's elections produces a sustained credibility discount. All four need to hold simultaneously for the bond market's current pricing to be justified. Historical precedent from 1998, the last time these yields were at this level, is worth examining carefully. In 1998, UK 30-year yields were elevated by global EM contagion and commodity volatility following the Russian default and LTCM crisis. The UK economy at the time was in better shape than bond markets implied. Yields eventually came down as the crisis resolved, and the Bank of England had room to cut. The parallel is not perfect. The Iran conflict involves direct supply disruption rather than financial contagion, but the shape of the divergence between bonds and the real economy rhymes. For the current gilt sell-off to prove correct, the inflation pass-through from $110 oil needs to show up in CPI data that comes in above 4% over the coming 2-3 months. If the April UK CPI print, due in coming weeks, holds below 3.5%, the bond market will have overshot. That is the first concrete checkpoint. The second is Thursday's election results. A leadership challenge within Labour would add a fresh political risk premium. A contained result, even with significant seat losses, removes one variable from the equation. The third checkpoint is any development at the Strait of Hormuz. European markets already demonstrated on May 5th that a hint of ceasefire talk sends Brent down 4% in a single session. A genuine resolution would trigger a sharp gilt rally. Evidence as of today tilts toward the bond market having overshot on speed, if not necessarily on direction. The economy holding up while gilt Europe spiked to 28-year levels is not a stable equilibrium. Either the real economy catches down to what bonds are pricing, or bonds rally back as inflation fears moderate. The Nissan announcement and HSBC's positioning suggest the industrial and financial sectors are already absorbing the shock, which argues for continuation of stress. But the economy's resilience through April, the isolated nature of the HSBC fraud, and the political risk premium's dependence on a specific election outcome all argue for partial reversion. Watch April UK CPI when it prints. If it comes in at 3.8% or higher, the bond market's 5.78% reads as prescient. If it lands below 3.5%, the gilt yield has run ahead of the data, and FTSE rate-sensitive sector will be the first to recover. The question that remains open is whether HSBC's warning about Middle East stress scenarios, where a mid to high single-digit impact on pre-tax profit is possible, is the bond market's thesis finally showing up in earnings, or a stress test that never gets triggered. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.